All right, we've all seen those giant profit numbers flash across the headlines, right? But what if I told you a company pulling in $10 million could actually be a worse investment than one making just a million? Sounds crazy? I know. Today, we're going to pull back the curtain on the one metric that really reveals the truth behind those big numbers.
So you look at this, and Company A seems like a total no-brainer, right? 10 million versus 1 million. But here's the thing. That headline profit number, it can be super deceptive. It just doesn't tell you the whole story. To really figure this out, we need a tool, something that cuts through all that noise and lets us put these companies on a truly level playing field.
And that tool, my friends, is earnings per share. You'll hear it called EPS. This is what solves our little puzzle. It answers a really simple but incredibly powerful question. How much of that profit belongs to each individual share of stock? See, this metric just slices right through the confusion of companies' size and gets to the heart of what your investment is actually worth.
And the formula itself is just beautifully simple. It's just the company's profit divided by the number of shares out there. That's it. And this is what gives us that true apples-to-apples comparison we're looking for. So all of a sudden, our puzzle starts to make sense. Let's say that $10 million profit is spread across a billion shares. Well, that's just a penny per share. But the $1 million profit, if that's only divided among a million shares, that's a full dollar per share. So which one looks better to you now?
Now, this isn't just some back-of-the-napkin calculation people do for fun. Oh no, it's actually governed by a global rulebook called International Accounting Standard 33. And the whole point of this standard is to make sure everyone is playing by the same rules. It ensures consistency, so when you compare the EPS of two different companies, you can be confident you're looking at numbers that were calculated the exact same way. And the rules get super specific about making sure that bottom number, the number of shares, is counted precisely right.
Okay, but that brings up a really important question. The number of shares a company has, well, it isn't always a fixed number. It's not always static. You've got things like stock options or special kinds of bonds that could actually create more shares down the road. So how in the world do we account for a number that might change in the future?
Well, the way we do it is by using two different versions of EPS. And honestly, the best way to think about it is with a pizza. Imagine you've got a pizza. Basic EPS is how big your slice is based on how many people are sitting at the table right now. It's a simple snapshot of today. But diluted EPS, that's the cautious what-if scenario. It answers the question, how big would your slice be if all the people you invited, but who haven't shown up yet, suddenly walk through the door? It's a more conservative look, a forecast of what could happen.
Yeah, that potential shrinking of your pizza slice, it actually has a name. It's called dilution. It's simply the reduction in earnings per share that could happen if all those potential shares become real ones. Basically, your piece of the profit pie gets a little bit thinner. And diluted EPS is the tool designed to show you exactly how much thinner it might get. So where do these potential new shares, our unexpected pizza guests, even come from? Well, the most common sources are things you've probably heard of, like stock options given to executives or special types of debt that can be converted into stock later on. You might also see other weird agreements that promise shares in the future. The point is, each one of these represents another potential claim on the company's profits. So how is this what-if number actually calculated? The best way to think about it is like a financial stress test. First, you start with the basic numbers, the profit and the current number of shares. Then you run that what-if scenario. You pretend that all those potential new shares, the dilutive ones, are issued right now. You add them to the total share count, you recalculate the EPS, and what you get is a really conservative, kind of worst-case look at the earnings per share.
Okay, great. So we've got two numbers, basic and diluted. But why should you, as an investor, or even just someone who's curious, care about the difference between them? I mean, what story is that gap really telling us? This, right here, is where it gets super interesting. That gap, it's a signal. If you see a really small gap between basic and diluted EPS, it usually suggests a stable, pretty straightforward ownership structure. No big surprises. But a large or a growing gap, that can be a bit of a red flag. It tells you there's a significant overhang of potential shares just waiting in the wings. Maybe it's from a ton of executive stock options, or maybe the company relies heavily on convertible debt. Now, here's the crucial part. A big gap isn't automatically bad, but you absolutely have to understand why it's there. And the only way to do that is to compare it to the company's own history, and just as importantly, to its competitors. So, if there's one thing to take away from all this, it's this. EPS isn't just a number on a spreadsheet. It's a story. Basic EPS tells you the story of the company's performance right now. Diluted EPS gives you a conservative peek into its potential future. And when you look at them together, they give you this incredibly powerful lens to see a company's real financial health.
So look, the next time you see a company's earnings report, please don't just stop at that big headline profit number. Dig a little deeper. Look for both EPS numbers. Because, as we've seen, EPS isn't just a number. It's a forecast written in the language of finance. And that really just leaves us with one final question to think about. What is your portfolio forecasting?